Good afternoon, good afternoon, good afternoon. Today is Thursday, March the 12th, 2026. Today's a down day in the market. It's down 84 points, also known as $84, almost $84, $83.47. Anyway, I have a trade that expires today in it. And just so you can see what this trade looks like, the zero, I have the 6625. So what I'm saying is this SPX, this S&P 500 index will not touch 6625. Right now it's at 6693, and it's down 80 something dollars, and I'm still far away, so that's pretty good. And I also have the call at 6860, so we already know. So basically, this index is going to expire worthless, so I'm going to keep everything that I received. But the reason why I'm coming on today is to show you how to basically own a stock or control a stock at a discount. So let's take MCD, which is McDonald's. Okay. Now, McDonald's is a $300 stock. So if I wanted to own 100 shares of McDonald's, I just click that go. So to own 100 shares, I would have to put up over $16,000, $16,242 to own 100 shares of stock. Okay, this is if you have margin, if you have cash, and then the buying power and the max loss will be the same, which is 32,472. That 32,472 just states that if McDonald's goes bankrupt, you're out $32,000. That's all that's saying. But we all know that McDonald's is not going bankrupt, so it is what it is. However, how can I? So since I don't have 16,000 in my account, well, actually, if I wanted to own or control 100 shares of McDonald's, if I wanted to trade 100 shares of McDonald's, to have 100 shares of McDonald's, I would have to outlay $16,000. However, instead of outlaying $16,000 to own 100 shares of McDonald's, what about if I can control 100 shares of McDonald's for a fraction of the price? So instead, that's when I'm going to now use options. So I'll go out to, like, let's say a year out, which is the March 2027. Let me see, 26, January, June. Okay, I'll go out to the January since there is no March. The January 15, 2027. If I click right now on this 330 strike, the stock is trading at 324. What I'm saying is I have the right to buy McDonald's if it gets to 330. Or actually, you know what I'm going to do is move it up to 320. So what this is going to do is give me the right to buy the stock at $320 in 309 days. Now, McDonald's is most likely going to be either up or down within those 309 days. I don't know when McDonald's is going to be in basically almost a year, because a year is 365 days. So this is slightly less than a year. But this is considered a long-term play here. But look, so instead of spending $16,000 to own 100 shares of McDonald's, all I got to spend is 3,285 to control 100 shares of McDonald's. So I don't technically own the shares, I would just control it. So to me, this is a much more cost-effective way of being long McDonald's without buying or outlaying so much capital for the share. So instead of putting down 16,000, I'm only going to put down 3,285. And then what I'm going to do is I can go and I can sell, like, let's say, a monthly call. So let's say April 17th, which is about 36 days away. So that's about a month. And let's say I sell the 340 call. So what I'm saying is this stock will not be above 340 by April 17th, which is 36 days from now. And I'm going to collect about $2 and about 90 cents, somewhere around there. So you see, so now instead of outlaying, so this reduces my cost basis by me selling this call. I reduce my cost basis by $2 and some change. And if I do this, $2 to $3 and some change, better state. So if I do this on a monthly basis, I can do this also on a weekly basis. Well, in this case, I'm doing it on a monthly basis. I'm not going to do this trade, but if I wanted to, all I had to do is click review and send, and I could now do this trade. Okay. And I could just keep selling calls each month or each week to reduce the cost basis. So eventually I can get it. If I do this properly, I can get this down to where it doesn't cost me anything for this call. Basically, I can get back to 2000 that I spent, but I'm not going to do this trade. But this is what you call a poor man's covered call, or PMCC, poor man's covered call. So this is a nice reduced way of controlling shares and still bringing in income off those shares that I control. I don't own the shares. See, because McDonald's pays a dividend. So because I don't own the shares, I don't get a dividend. But the dividend is going to be small compared to the premiums. That I'd rather spend less to control the shares than spend because let me see, almost 3,000. So 3, 6, 9, 12, 15, or let me see, about 13,000. So 3, 6, 9, 12, about four times, spending four times the amount just to get a dividend. No, I'm not going to do that. So this is a much more cost-effective way of controlling shares and making money. So this is something that I just wanted to go over real quick with you today. And let's see, the markets is about to close in about a half an hour. So what I want to do is a trade for tomorrow in the SPX. So what I'm going to do is I'm going to go to that 10 delta. Actually, I'm going to go less than 10 delta because I think the market could drop tomorrow. Let's go to the 6 delta. So the 65.25, we do 20 points wide. So that's 65.05. This gives me 85 cents. I can actually go a little further down. Let's say 65 cents. $65. Okay. So this gets me at a 5 delta for tomorrow expiration. And then I'm going to go to the call side. This is basically what I've been doing on the SPX this week. I'm going to go to a 2 delta. Gives me 90 cents. I want to go a little higher. Let's go up to let's see, 100, but I want it after fees and commission. So I'm going to go a little higher. 650, 670. So it's $2, 205. Just go a little bit higher than that. 40. Okay, this is good. This is good. So I'm at a 4 delta on the call side. So that means I have a 96% chance of making money on the call side. And on the put side, I'm at a 5 delta. So I have a 95% chance of making money on the put side. So if you notice the here on this total trade, this pop, probability of profit, I got a 90% chance of making $115 by tomorrow. And I'm just putting up just under $2,000 of buying power. So $108, that's what I'm going to receive, minus the commission and fees. Let's see if I get filled at that price. I got filled at that price, so that's good. Okay, so that's the trade that I did for today. For tomorrow's expiration, I get $108 that comes into my account immediately. I can do whatever I want with that. Um, my wife is in Ghana right now, so she needs money. So I'm gonna just turn around and send her that money. So basically, but notice that that money didn't really come out of my pocket per se. The market is paying for that. So that's what I like to do. Anytime I got an expense that I got to pay, just go into the markets, go collect some money to go help pay for that expense. So this way, I keep my capital. That's the whole purpose is, to keep your capital. I don't care if the market can go up, it can go down, just as long as it stays above 65, I mean 65.15. And right now it says 66.93 or stay below 68.40. As long as the market stays between those two, I'm guaranteed to make money. And so, all right, we'll see how this trade turns out tomorrow. Talk to you later. Bye bye. Good afternoon. Good afternoon. Good afternoon. Today is Friday, March the 13th, 2026. I don't know, this whole thing about Friday the 13th, that's when Jason Voorhees and, that whole, yeah. Anyway, that's just a weird thing. Anytime, I hear, Friday the 13th. But anyway, it's the afternoon. It's about 1:55 p.m. The markets will be closing, about, because it's 2, so in 2 hours, the markets will be closing for the weekend. And I'm just coming on to quickly update some of the things that I did. I closed out my crude oil trade, the /CL trade for a win, another profitable trade. So basically, the gas that I put into my wife's car basically paid for itself. So basically, got that money back and then some. Um, in my video yesterday, I showed you when I a particular strategy called the PMCC, also known as the poor man's covered call, and I did that on McDonald's. Remember, I showed you the example. Well, I actually did that with this company called NVIDIA because they are big in the AI space, and so um, and they're one of the top chip makers anyway. So NVIDIA, what I did was I bought a call, a leap. It's not quite a leap. Well, yeah, it is a leap because it's over 371 days. So there's 365 days in a year. So technically, this is a little bit over that. So it's a leap call option. So I bought it at the 185. It's down today, but that's okay. And what I did, and here's where they call it the poor man's covered call, because when I bought that, I paid $3,700 to buy that. $3,718. That's how much I paid. Okay. Because if I was to buy 100 shares of NVIDIA, let me see. I don't know why. Get out of the way. This is in the way. Okay. If I was to buy 100 shares of NVIDIA with the stock right around 100, I mean, 18, $180, okay, I got to put up. So I have to put up almost over $9,000 of buying power just to buy 100 shares of NVIDIA. So rather than spend $9,000 to buy 100 shares of NVIDIA, instead, let me cancel this. I spent 3,000. Well, we go back to my position. Sorry. I spent $3,718 to control 100 shares of NVIDIA. So I'm basically saving $6,000 to pretty much get the same effect because I'm not worried about no dividend play here. And so not only did I save $6,000 in how much I'm purchasing, now see the downside to this though is that this can expire worthless, which means I can lose the full $3,718. Where if I bought the shares, I can theoretically hold them forever. You cannot do this. This contract expires in 371 days. Okay. But what I also did was, excuse me, I went out to 7 days, which is next Friday, March the 20th, and I sold a call option at 192.50, which means I'm betting that NVIDIA does not get above $192.50. And I collected $1.69 or $169 because it's 100 shares, because each contract controls 100 shares of stock. So I reduced my cost basis by $169. And I plan on doing this and already I got already almost $60 of it in one day because I did this yesterday. By the way, I put this trade on yesterday and I already got $60 of the 169 that I collected. So what I'm going to do is keep just doing this every week, bringing in some income to reduce this cost basis. And if I do it properly, I might end up at the end of the year having a zero cost basis or a very small cost basis if everything goes right. So that's the goal on this. This is called a PMCC, also known as a poor man's covered call. And this is a nice way to rent out stocks without necessarily owning it. So this is really, again, I'm not giving financial advice. I'm just telling you what I'm doing. Um, I'm helping a student in New York. Her name is Shelda, a friend of mine's, and basically, she went back to school, and so she's not working. And of course, she lives in New York. In New York, you got expenses and stuff like that. So I've been helping her manage her account, where she's been drawing weekly and monthly incomes to help offset the cost of living in New York. So basically, I've been helping her pay her bills. and stuff like that and withdraw money to do whatever she needs to do. And this is one of the strategies that I helped implement in her account, or showed her how to implement in her account. So I'm not doing anything that I haven't taught someone else. So just so you know. Now, the only difference now, what I am doing that's a little different is you see this SPX. This is the S&P 500. I'm doing the same strategy. The only difference is with her, I'm teaching her to go at least a week out. So this way she makes weekly income. Though if you're just starting out, I would not recommend doing weeklies or dailies or day trading or anything like that, or one day. I would recommend at least going a month out so this way you can get the hang of it without having to, watch the market consistently and stuff like that. But for her, she wanted to make some money on a weekly basis. So I showed her how to do that. Excuse me. So basically, using the same strategy, we're doing iron condors, and right now, what I did when I set this trade up, I did this yesterday for today's expiration. That's why I say 0 day, and that's the 60. I'm saying that the S&P 500 will not get down to 65.15 by today. Right now, the S&P 500 is at 66.40. So this is going to have to drop over 100 points in 2 hours in order for me just to get tested. That means I might, in other words, to get just to that strike, and the likelihood of it dropping 100 points is very minimum. That's why you see this delta at 0.01. So that means I got a 99% chance that the S&P 500 will not drop to this price in the next 2 hours. That's all that's saying. And on the call side, I'm saying that the SP if the S&P 500 will not go above or get to 68.40. Okay, that's why if you notice the delta here is 0, which means I got a 100% chance that it will not get to this price by in the next 2 hours. And what did I did want to collect on this trade? 115. So that's how much I collected. That's why you see here right now it's saying 135. This will just move down to about 115 to close out at the end of the day. I'm going to just let it expire worthless. I could close it out. Matter of fact, you know what? Let me close it out now just to free up the buying power because it's the weekend. And so, no, I mean, even though we close position, I can buy it back for 10 cents. So I collected $1.15 and I'm buying it back for 5 cents, 10 cents. I free up almost $2,000 of buying power. Well, let's see if that clears. I'll let that clear. Right now it's working. If it doesn't clear, then I mean, if it doesn't fill, then it just expires worthless, which means I keep every dime anyway. So it doesn't matter to me. So I'm not worrying about that. Now here's the /NQ. This here is the NASDAQ futures. Now this I did a day trade on, which means I put this trade on earlier today. I collected $125. And right now, I can keep about almost $50 of it right now. You know what I'm going to do? This thing is very volatile. Boy, this Nasdaq really moves. Look at that; it's down $168, $170, and yet look where my strikes is at. Look how far. So I'm betting that the Nasdaq futures doesn't get down to 24,230. And it's saying here it's got 11% chance. I mean, 11% chance of it getting to that. So that means there is a 89% chance that it will not get to that price. But what I'm going to do, and I just did a put spread, a 100 wide. So I sold the 2430. I mean the 24,230. I bought the 24,130. So that's a 100 point wide spread. And basically, I collected again $125. If I had closed this trade out earlier, I would have kept all 125. But again, because it was up big time, but then it just turned around and dropped on me. So that's why now I'd rather come away with some profit. I don't want those $19. I'm gonna wait on this. Because again, it's got about 2 hours. Well, really, let's say an hour, because then they're gonna probably close me out in an hour on this because these are the futures. So because the futures is a little bit more riskier because of leverage, because this uses what is called span margin, unlike the regular equities like SPX and all these other symbols here that you see. This is known as T margin. And this is in a T margin account. This is using what is called span margin, which is a little different. It allows you to have more leverage, but of course, with more leverage comes more risk. So you have to really know what you're doing when you're dealing with futures and stuff like that. Luckily, I know what I'm doing. I've been taught well. So um, let me see. I make a nice $21 profit. It's fine. I just close this out. We'll take this risk off the board. It's still profitable. I'll free up about $1,500 in buying power. Okay, so that went through. So basically, I ended up keeping 20 out of the $100 or so dollars that I collected, which is okay. It's profitable, so that's the most important thing. I mean, so I ended up making $20 on that. Ugh. I rarely touch the forward slash NQ, which is the NASDAQ. But it allows me to do day trading on there without having to worry about having a certain amount. I see right now to do the equities here or the SPX, you gotta have what they say an account 25,000 or above to do day trades. Well, the beautiful thing about the futures, like the forward slash NQ, forward slash ES, forward slash CL, these are some of the futures that I trade. Forward slash, I don't do so much the MES, um, or forward slash G, for gold. Um, I can day trade those without having to worry about getting what is called a PDT, a pattern day trading, because it uses a different margin. I think span margin doesn't have the same or same requirements as regular margin has. Um, so it allows me to day trade. Um, the markets did reverse itself because it was up earlier today, so that's why you see a lot of red here. But my positions are in good shape. I mean, I'm bringing in cash flow on a lot of these positions, so I'm actually doing well with this, and that's fine. But so if you are interested in learning more about this, subscribe, give me a thumbs up, or comment, let me know. I could teach you this. You don't need a lot of money to do this. That's the beautiful thing. You can get a cash flow with as little as, I say, about $1,000. But what I would tell people is that to start to really learn this, the best thing to do is to do it in a virtual account where you're learning for free, where you're not putting any money, real money at risk until you know what to do. That was the one thing that if I had to do it all over again, I would have given more heed to working in a virtual account because at least you learn the strategies how to make. See, the one thing is when I'm if you notice, like let's say the SPX, when I'm putting on these spreads here right now, to buy it back, I would have to pay 11 cents. I don't want to pay 11 cents. I'll leave it at five. Again, if it doesn't get down to that, then it'll expire worthless. So I'm not worrying about it. But to put on these type of spreads here, the key is knowing how to manage it. That's why Tasty Trade, they teach trade small, trade often. And I see why they say that because when you trade small, when positions go against you, it doesn't hurt you so bad because you'll know what to do. You'll know what adjustments to make, this, that, and the other. And you always want to have capital aside to make adjustments because that's what this is about, learning when to make adjustments when things go right. Think of it like being in it. What the why airline pilots, there's a reason why they use simulators to learn how to fly. Technically, planes fly themselves. They can use the autopilot. The autopilot pretty much flies the plane. So pilots don't really fly the plane. But what are they there for? When things go wrong with the plane, they're supposed to have the expertise to know how to guide that plane down as safely as possible. Now, sometimes, certain things happen and there's nothing that can be done. But their main job is to get you from point A to point B as safely as possible with as few human lives affected as possible. So that's the goal of an airline pilot. Well, a trader is no different. A good trader understands that, you know, when things are good, yeah, it doesn't require much education or to learn much. But it's knowing what to do when things go bad because things does sometimes go bad in the markets. Like right now, the market is down almost $30 in the SPX. But again, I don't care if the market goes up, stays flat, or goes down. Okay, I really don't care. The only thing I care about is where is it not going. Because if you know how to make money, regardless, if you know how to set your trades up, you can make money regardless what the market does. But when the market does something that you don't expect, how do you adjust? And that was the one thing that I've always struggled with until recently, when, like I said, I was taught very well now how to fix the trade when it goes wrong. Because that's what separates traders is or traders, because investors don't really adjust trades. They just more or less buy it and they'll hold on to it. Where when you're trading options, especially if you as a trader, you have to know how to make adjustments when things doesn't go in your favor. And so that's what starts to separate the amateur trader from the professionals. So I mean, I thought the markets, because the markets was going up today, so I thought today was going to be a good day, a nice green day. But unfortunately, the market turned. But it doesn't matter to me because I end up still being profitable on this trade, and most of my positions is still doing well from a cash flow standpoint. I'm just bringing in some weekly income each week, so it helps me to pay my bills. And right now, that's very important. So I'm just showing what I have done. It's nothing really complicated, but it just takes time to learn. Anyway, have a nice day.